So, hello guys, good morning, good evening, and good afternoon to you all. Recently, I was analyzing the automotive sector, specifically the two-wheeler segment and three-wheeler segment. I came to know about the largest company in India which manufactures two-wheeler and three-wheelers is Hero MotoCorp. So I decided to make the financial model of Hero MotoCorp from scratch in which we can analyze the financial statement uh, and value the company through DCF valuation by forecasting its revenue and expenses with respective assumptions. So we have done the same. We have taken some assumptions to forecast the revenue growth and expenses of the company, and we have also analyzed the DCF valuation of the company, in which we have taken the three scenarios, which is base case scenario, best case scenario, and worst case scenario. So, according to the assumptions, we have taken the scenarios, and later we have also done the ratio analysis of the company, Altman Z-Score analysis of the company, and also the DuPont analysis of the company, which three part of the model. So firstly, we will start with the income statement, what we have done exactly. So we can see that sales growth of the company is around 7.16% from last 5 years, and we forecasted the sales growth. So it came to be around 8.70 average sales growth of the company in next projected years. If we come at the cost of material consumed, we see that the COGS growth from last 5 years was around 6.52%, and the COGS growth in projected expense is around 9.87%. This is mainly due to the rising cost of commodities and supply chain disruption due to unstable global scenario. Gross profit of the company has grown with around 8.81% from last 5 years. So what is the percentage of gross profit we can see over here is as follows. What is the gross profit margin company has? So we can see that company has around 30 to 30, 33 to 35% of gross profit margin in last 5 years, and in forecasted years we get the gross profit margin of the company as follows. Uh, yeah, so we got the gross profit margin of 34 to 30%, which is decreasing order from financial year 26 to 30. So yeah, the gross profit growth is averaging about 8.81% in last 5 years, and in next forecasted years we have growth of 4.72% in gross profit, which shows the steady growth in profit margins of the company. The working capital here, if we talk about the working capital, we see that company is operating continuously into the negative working capital, and this is due to the most of the manufacturing companies use the suppliers credit to get the working capital negative, and this is a best case where if the company is uh, getting growth through negative working capital, it will be the best scenario. If company could operate with the lowest cost of fund, then it is better. This is the lowest cost of fund which company is getting, and it is operating with a more growth, better growth. And later, if we see the employee cost is around constant, if we calculate at the percentage of sales, around 6 to 7%. If we see it here, let's see. We get the employee cost as, so almost constant to it's almost constant to 6 to 7%. Yeah, see, the employee cost is constant to 6 to 7% in last 5 years, and if we forecast it, it is also 6% of to the percent of sales. Finance cost is continuously increasing, but it is not it is a little growth, not too much big growth over the last 5 years of period. So here comes the depreciation. We have depreciation cost, which is around 2 to 3% of the sales. Then if we go to the profit before tax, profit before tax has grown from 1.94% in FY21 to in FY25 it has grown to 14%. That's a massive growth. So yeah, we get the average growth of 11.5% in the profit before tax, and in forecasted revenues, we forecasted years, we get negative 0.64% of profit before tax growth, average growth. Right? So yes, one thing we have to see that the net profit margins have been constant from increased from 7 to 11% in last 5 to 6 years, and later in the forecasted period it has been continuously decreasing from 12 to 7%. If this is the most important part is EBITDA. EBITDA has been here. EBITDA margins of the company was as follows. This is we get the EBITDA margin of the company around 14 to 15%, which is, and in forecasted uh, years we get the EBITDA margin of around 17 to 13%. So we see that the EBITDA margin are ranging from the 12 to 15% in last 5 years, and in forecasted year it is same as we see in the last 5 years. So yeah, operating margin growth, average growth in last 5 years was 15%, which is a good sign. And if we see operating margin has been 10 to ranging from 10 to 15% in last 5 years, and same trend is has been observed in next forecasted years. So yes, we have then retained earning over here and uh, dividend distributed. So what is the thing we cannot forecast what would be the dividend given to the shareholders very accurately. So you may take the average of dividend what has been delivered to the shareholders last 5 to 10 years and forecast it according to that number. So next we go to the assumption sheet. This is the most important part here. So if we analyze the total volumes sold by the company, we see that company has degrowth of 1.18% in last 5 years in its volume. Uh, so we clearly see that the company has played its game on increasing price because volumes has been seeing degrowth from last 5 years. So yes, later in the recent con call, management was very optimistic about the volume growth in next 1 to 2 years due to the various steps taken by the Indian government to boost the economy. Like government has reduced recent GST rates and reduced the income tax slabs and also injected the uh, money into the economy. So yeah, RBI has also taken some steps. RBI has reduced the repo rates recently in the past December 25. Last repo rate decrease was there, and RBI has also done the open market operations in the bond markets, which has also improved the liquidity into the banking systems. And yeah, credit quality is also improving. Due to this all factors, we can see that there is marginal growth in the economy. GDP is growing around 6 to 7% recently. So average optimal growth rate we have taken for the total volume of the company is of 4 to 5%. So yes, uh, and the total capacity of the manufacturing capacity of the company from last 5 years has not been increased so much. That is 9.4 million a total capacity. And if they are planning to increase in next 4 to 5 years, we can change accordingly. So yeah, if we see that capacity utilization of the company is around 60 to 70% in last 5 years, which has grown to 78% to in year or to financial year 2030. Okay, so total if we compare the total sales volume of the company to the total sales volume of the industry, we see that in financial year 26 the volume has grown by 32% to around 26 million units, which is a massive growth. This is due to the same reasons which I mentioned earlier, that is the expansionary policies by the government and the RBI, and the government is trying to strengthen the domestic market, uh, and this all sales key growth drivers are from the domestic markets and urbanization of the uh, cities. People are also going towards a premiumization. Due to this, companies are focusing on improving their product to premium side. This is leading to the improved margin of the companies. And if we see that market share of the Hero MotoCorp, which has been continuously showing degrowth from 38% to 29.45% in last 5 years. In next forecasted 5 years, we can see that the company has degrown its market share from 23 to 19%. Okay, and this is the most interesting part we have here. We have calculated realized revenue per unit. That is how we have calculated it. We have taken the total sales of the company in FY25 and divided by total sales volume of the company that year. We get 45,725 rupees of realized revenue per unit, and this has been growing since last 5 years with 8.81%, average 8.81%. We see that. So recently, from last 2 years, the company has not seen the realized revenue increase in realized revenue per unit more than 5%. So we have taken the average growth, assumed the average growth of realized revenue per unit from 4 to 5%, 4 to 5% in last forecasted 5 years. If we see about the cost of goods sold and expenses of the company, which has been growing, expenses was lowered by the company. Company has lower cost of goods sold growth. per unit, uh, and that too was highest growth was in the FY 2021, and in FY 2025 we have the cost of goods sold growth of 2.19%. The growth is continuously decreasing in last 5 years, and we see if we see the next forecasted year, we can see that due to the recent rise in crude oil prices, the inflation may jump to 3 to 4% in coming quarters or coming years in India. That would really affect the cost of goods sold per vehicle. So we have taken the optimal growth rate of 4 to 6% in cost of goods sold. Yeah, so what would be the effect on the gross margin per vehicle? So company had the gross margin per vehicle ranging from 30 to 35%, and which was continuously increasing from last 5 years from 31% to 33%. But recently in FY25, we see that the company has decreasing trajectory of gross margin from 33 to 30%, which shows that increasing in cost. This is mainly because the increase in the commodity cost which company is bearing over the last 1 year due to global uncertainties. Now, if we come at the other line items of the income statement like SG&A, we see that it is ranging around 6 to 7% from last 5 years, and we have taken the average growth of 5.18% for next forecasted 5 years. Employee benefit expenses same. We see that percentage of employee benefit to the sales ranges from 6 to 7% from last 5 years, and we have taken the average percentage of sales of employee, that is 6.39% in next forecasted 5 years. Finance cost, we see that average finance cost lies between 0.194%. So we have taken the optimal pessimistic view. The finance cost is 0.157% of the company. But main part of is their main line item of depreciation, which is around 3 to 2 to 3% from last 5 years. So we have taken the pessimistic view of 2% when growth in the depreciation in next 5 years. Assuming that company is not doing the massive capex. If company is doing the massive capex in next 1 to 2 years, then it may change accordingly. Other expenses seen 11 to 12% is the range. We have taken 12% as the constant growth rate in next forecasted years. Tax rate, if we see the tax rate, the statutory tax rate in India ranges from 22 to 23%. And yeah, here company's average tax rate for last 5 years comes out to be 24%. So we have taken the modest 23% growth rate in the tax for next 6 years. Now we have done with this, and now we have to go to the most important part, that is uh, we have to go to most important part. Now, if we analyze the most important part of value model is that DCF valuation. We have taken the EBITDA into 1 minus tax and added depreciation into tax into it to get no PAT. So we got no PAT here. And if we subtract the capex and working capital, change in working capital from no PAT, we get the free cash flow to firm. So now here comes the question how we have calculated the capex of the company and working capital. So let's come over here. We have assumption sheet over for balance sheet. Capex we have taken from the annual report, which which is given by the company for every year. We have taken the capex what the company has done. How? So we have the column of gross assets in the annual report. So what we have done is that taken every year of gross assets and then subtracted it with the previous year. So we get the what is the improved capex company has done. So improved in asset we get as follows. The other way we get the capex is that in the cash flow statement, we have investing cash flow. So what is the cash outflows for the fixed assets and uh, purchase of goods in the investing cash flow. So if we take that, we can get the capex in that form also. Later, we see that the capex as a percentage of sale is varying from 2 to 2.5%, and we have highest capex percentage of sales in 2020. The latter we have the range of capex percentage of sale to 2 to 2.5%. So we have taken the pessimistic view of capex, that is 2%. It may change accordingly if we see more analysis about the company's capex schedule. So later we have the analysis of working capital. Inventory we have ranging from as a percentage of sales from 4 to 5% in the recent years. And yeah, the growth in inventory, average growth in inventory was around 11% in last 5 years. We see that we can take the uh, inventory percentage of sales, that is 4.87% for all forecasted year. And receivable, same as the inventory, we have range of receivable as a percentage of sales from 5 to 8%. So average we are getting is 7.02%. So we have taken it as for the next forecasted years. So payable we have same as ranging from 10 to 13%. We have average 14.57% of growth in percentage of sales we have taken in the next 5 years. So we get the working capital for forecasted years and last 5 years. We have the negative working capital over here, as I said earlier, and change in working capital is as follows here. So we have calculated the two main part of the DCF valuation, that is capex and change in working capital. If we connect this with that reference, we get the free cash flow to firm. And about the terminal value, we have the terminal value also here. So let's calculate the terminal value. How I have done the calculation of terminal value. So yeah, we have free cash flow for financial year 2030 here. If we multiply it with the growth of GDP for GDP growth rate, because see, a company cannot grow more than the growth of GDP in infinite years, next infinite year. So if company grows at minimum 0.1% above the GDP growth, then it will overtake the country's GDP in next few years at some point at in next few years. Then this can't happen. So if we take the GDP growth rate as 1 plus 5% and divide it by the required rate of return, that is WSEC, we get here. And subtracted by, okay. So yeah, we get the 72,160 crores of uh, a terminal value. So if we divide it by the discounting factor, we get the present value of all the free cash flows to firm. Now, if we add all the free cash flow to firm, we get the enterprise value for the firm. Now, if we subtract the market value of debt from the enterprise value and add the free cash to it, then we get the value of equity. Value of equity we got is 61,775, and this now we divide value of equity we divide by the number of shares outstanding, then we get the value of share equity per share, that is 3087. We got this value as intrinsic value. We see it through the DCF model. And if we see how we have calculated the WACC, which is the most important part of the DCF model, like we have taken the cost of equity. How we calculated the cost of equity? It has been calculated by CAPM model. So what is CAPM model now? CAPM model tells us the what is the cost of equity, which when we compare it with the risk uh, with reference to the market. Now the formula is as follows. We take the risk-free rate and add it to the beta of the company. Beta is the risk of the company, but as compared to the market. Okay, so yes, beta into equity risk premium. Equity risk premium is the what is defined as the extra return we are expecting from the risk-free rate, that is market returns. So extra market return we got from the above the risk-free rate. So we subtract a risk-free rate from the market return and multiply it to the beta, and then add the risk-free rate. We get a cost of equity for the firm. So this was about the cost of equity, and now how we have calculated the cost of debt. That is, if we divide the recent interest paid by the company to the total debt of the company, we get the cost of debt. And in this way, we have also calculated the debt to equity ratio of the company with equity and debt capital allocation. We can see that debt to equity ratio of the company is 0.03 recently, and we have with this we have calculated the weighted average cost of capital is 16.89% here. We use this as a so this is the minimum required rate of return company has to generate to remain in the market and to cover all the costs. Yeah, so this was the DCF model we have done with this, and we come with the to the ratio analysis now. In the ratio analysis, we have taken the profitability ratios, that is gross profit margin, EBITDA margin, EBIT margin, and net profit margin. So from the gross profit margin to net profit margin, if we compare the gross profit margin and net profit margin, we see that in Y22 and 20 there was higher gross profit margin, but it was not able to convert it into net profit margin. So therefore, the ratio was counted to 4.46. But in the preceding years, we see that the ratio is decreasing. That means that net profit margin is increasing as a percentage of gross profit margin. That is good sign for the company. Company is able to generate higher net profit margin than than as compared to the gross margin. We see that. So, but in forecasted years, we see that the ratio is continuously increasing. That shows the lower efficient conversion of gross profit margin into the net profit margin. In activity ratios, we have inventory days, which are ranging around 16 to 18 days. Receivable days has been constantly increasing from 18 to 29 days from last 5 to 6 years. And if we go to payable days has also been increased from 37 to 50. But in last 3 years, it was constant from 50 to the 50 to 53 range. And if we see that the cost conversion cycle, it is continuously being negative from last 5 years, which is a good sign because company is able to convert its raw material into the cash very fast, and it is utilizing cash very efficiently. And so if we see that capex to sales, Hero MotoCorp, which capex percentage of sale is ranging around 4% in FY 2020, and later years it is ranging around 1 to 2%. In Bajaj Auto, we see that the capex to percentage of sale, the percentage of sale is ranging from 1 to 2%. But in TVS Motor and Eicher Motor, the capex as a percentage of sales ranges around 5 to 6%, which shows that this both companies has done massive capex in last 5 to 6 years, which is also been seen by its revenue growth. If we go to the revenue growth of these companies, Bajaj Auto has saw the growth of from 29,000 191 crores to 50,995 crores. So this was the average growth. If we see average growth here was uh, around 12%. And if we go to TVS Motors, which has done the massive capex in last 4 to 5 years, it has seen the average growth in the revenue is as follows: 19% growth. It has average growth 12% of growth. It has 19% of growth, and Eicher Motor saw the growth of 16% of growth. We see that TVS Motor and Eicher Motor has the highest growth rate in their revenue from last 5 years due to the massive capex done in the operation in the business. So this tells us that the more the company will do, the more company will be doing its capex towards the operation. There will be the more growth converted to the sales. And now we come to the Hero MotoCorp, where ratio analysis. So yeah, we saw the growth matrix over there, capex and growth matrix. So debt to equity solvency ratio says that 0.014 to grown from 0.014 to 0.024 from last 5 to 6 years, which shows that the company has improved its debt, increased its debt, and debt to EBITDA ratio has a modest growth from 0.05 to 0.06, which is in the safest zone. Now we come to the interest coverage ratio of the company, which has grown from 70 to 89 in last 5 years, which is a good sign. Return on equity has been growing since last 5 to 6 years, and it has grown from 9 percentage point from last 6 years, which is a good sign. Return on asset has also grown from 11% to 17% in last 6 years. Return on capital employed has also been growing with the 10 percentage point from last 6 years, which shows that company has been utilizing its assets efficiently and managing its money more efficiently. Now, leverage ratio, financial leverage has been increased from 1.46 to 1.54, and degree of operating leverage from 3.99 to decrease from 3.99 to 2.05, which questions the efficiency of the company, operating efficiency of the company. And degree of financial leverage has also decreased, which is better for the company. Now, if we go to DuPont analysis basically tells us about the reasons of reasons behind the improve or increase or decrease in the return on equity. We basically analyze the how the return on equity has been increased. What were the reasons? So if we see that there are three factors in which we analyze the return on equity. First is net profit margin, asset turnover ratio, and there is financial leverage. If we see, net profit margin has grown from 7.47% to 11.20%, and it has been constant. It has gone to the asset turnover ratio was 1.53. It was constant around that time consolidation phase, and financial leverage was has also increased in the modestly from last 6 years. So mainly the net profit margin has impacted the ROE, which has contributed to the growth of 9 percentage points of ROE. Now, if we go to return on asset, return on asset has been increased from 11% to 17%. This has been increased due to the increase in the ROE and increase in the financial leverage ratio. Yeah, graphically, if we see, we can see the growth in ROE from last 3 years, and net profit margin has also grown from 8% to 11% from last 3 years. We see that asset turnover ratio has grown by 0.4% in last 2 to 3 years. Financial leverage ratio is continuously increasing, and now it has been stabilized over 1.52, which has also grown the return on assets of the company. Now, if we go to Altman Z-Score analysis, we see that the Altman Z-Score basically tells us what is the probability of the company to go bankrupt in next 1 to 2 years. So there are 5 factors we analyze during the Altman Z-Score analysis. That is working capital, retained earning, EBIT, market value of equity, and sales. So if we divide all these factors with the total assets, we get the ratios, and there are various weightage of these ratios. Will discuss it later, and we calculate one number, that is Altman Z-Score. If the Altman Z-Score is less than 1.83, then the company is said to be weak and may go bankrupt in any of the time. But if it is between 1.83 and 3, it is in the gray zone. It may go bankrupt or may not go bankrupt. There are 50-50 chances. And if it is greater than 3, it is in the strong zone, and it is basically having the better lower probability, but lower probability of going bankrupt. Yeah. So this was the basic financial model which I have created from scratch. If you want, I will be making video on how I have built this model from the scratch, and You comment any company on which you want me to make the financial model. I will make it for you with all the assumption sheets and forecasting. So thank you for watching the video, and please comment if you like it. Thank you.